Welcome to our second quarter update for the residential segment. We're excited to talk about how things went this quarter, and overall it's a very positive quarter on the residential side. So we're going to get into kind of what's happening in the market, what went well, and what the opportunities are that are out there. So.
Yeah, I mean, a quick look back is like, you look at the transaction data from 2021 and 2022 compared to the last 3 years, compared to the prior 8 years before that. I mean, that was just a complete anomaly of a market that we were in.
Yeah, it was massive. 21 and 22 were off the charts. Looking in the rearview mirror now, it's like, wow, that was wild. That was a wild segment.
Yeah, on average, it was 2 to 3x a normal year over the last 12 years of transactions.
Yeah, yeah. And now 2025 has been a little bit better than 23 and 24, essentially, but still nothing like. I feel like that 2021 experience is still kind of like what people are expecting,
right?
And it's not. That was an anomaly. Nothing's going back to that.
There were a lot of businesses built on that model of those 2 years and started on that model, and now people are still kind of justifying or rectifying what the actual normal is.
Yeah, it's not that.
Right.
No. So when we look at just how the quarter went and where we were at, one of the main things we always talk about is retention. We're in the low 60s. Our target is in the 70% retention range. The market as a whole, it's been lower, but that's because, there's a lot of product that came online, and a lot of it is really fancy.
Yeah, I mean, you're talking hundreds of thousands of units brought online. Even in Atlanta alone, you're looking at tens of thousands of units brought online.
Yeah, we were looking at a deal here. We'll put a picture of it up too, but it's like the rooftop has an Airstream lounge. It's certainly very fancy and it looks cool, but on the retention side, you're constantly competing with this new product that's coming online. They're being aggressive on pricing because they got to get things occupied, and a lot of that was started in the 2022 segment, and now it's live, and they need to get some residents.
And that specific example wasn't even an urban infill project. It was in downtown Swanee, which Swanee is probably hour and 15 minutes
North
suburban of downtown Atlanta. So it was in their little historic downtown, which is a cute suburban downtown that we have a lot of these in Atlanta, but it's a very suburban product to have that type of amenity on it.
Yeah, and a price point on that deal was, that deal recently traded. It traded for roughly the same price as it did in 2021, right when it was built. So it's been around for a few years now, and but pricing is still. That was $280,000 a unit. That is an expensive apartment acquisition. Right. All right, so if we look at our revenue was up 2% for the second quarter compared to the second quarter of 2024. That's well below numbers we were seeing, again, back to that 2021, 2022.
Peak inflation era.
Right, yeah, when we were seeing pretty huge numbers. We're looking at not rental rate changes, but actual revenue growth of 2% over that quarter. For the first time in a while, we're seeing our overall pure dollar cost of operations decline. So we were down about 8% from the first half of 2024. So we look at Q1, Q2 of 2024 to Q1, Q2 of 2025. Our overall expenses, everything baked in, controllable, non-controllable, CapEx, all that stuff, was down about 8%. So we saw margin growth this quarter.
And that was, for our property set, that was a fairly normalized window of time, meaning that we weren't doing heavy renovations really before that, after that, or during that. It was really just pure property operation. So you wouldn't see really a spike. It's more just standardized day-to-day cost.
Yeah, what that translated to was a reduction of overall costs. Our net cash margin was 11% for the second quarter. It was 13% in the first quarter, but overall for 2024 is 4.2%. So 11% is strong on the cash side of the business, where we're seeing what are we making on revenue. Right? So, all right, so let's go into just some of the things that are basically like we've got to address, and there's issues with them. And one of them right now that we're looking at is really like, how does is technology improving the business, or is it harming the business, or what is it doing? We've always been very quick to adopt technology and try and bring that in-house and make our business as efficient as possible. But it doesn't always, I would say it doesn't always go in the right direction.
Yeah, I mean, what we're seeing in general is that there's usually some really unique, new approach to solving a business problem. We get excited about it. It's relatively low cost compared to the manpower at the time. We get in, we get fully engaged. Their hooks sink into us, and then every year we get a 20% increase and a 20% increase. And you look back 3, 4, 5 years, and you're paying 3 or 4, 5 times X what you did when you initially signed up, and now you can easily put some people on it at a fraction of the cost. One good example is that when we were looking at our accounts AP, accounts payables. We signed up with a service. They were doing bills for a couple pennies a bill, and after a couple of years, what was it? A couple of dollars a bill?
Yeah, it turns into dollars, and then it's like, hey, why isn't it just $5 a bill?
Yeah. And so we ended up we ended up hiring 1 or 2 people, 1.5 people to basically put on this, and it was a better solution for our business, and it was lower cost.
So that technology, I mean, there's all sorts of options out there of bring in prop tech and it can make all this stuff better. And it's like a lot of the times it can't. But when we brought in, essentially it sold us like, we're gonna use AI to scan in your bills, to do everything. It's like, well, man, it misses some things, or the cost becomes too high, and it's like, oh, it's frustrating because the technology isn't always that immediate value add that it's, that it's out there looking like.
Yeah, but from our standpoint, we like looking at those opportunities and taking that risk, but we've been burned so many times, we've become much more reluctant to doing the next new thing, knowing what happens.
And another one, I mean, all of this really goes into how do we make sure we are operating as efficiently as possible. We look at our overall controllable expense ratios. They've been pretty flat for the past 6 quarters, but we're doing everything we can to maintain that margin. One of the other ones we've seen on the technology side is really, one, how do we do things as efficiently as possible? But we were talking, 10 years ago, you're posting a flyer to go try and get a tenant. Put up a little pull tag with a phone number on it, kind of old school way of doing stuff. And now so much goes through apartments.com as like, hey, that's your advertising strategy, or doing anything for online leads to generate applicants. Well, now we get so many spam and unqualified leads that are just being inundated into our system. You almost need to have technology to go handle all that. Was when we didn't have it before, we just had really only a couple qualified leads, and that's how we went about the leasing process. Now we get so many leads on, we're getting hundreds for a single apartment, but 90+% of them are spam. That's in there. And, that's one of the other challenges we've seen with, if we advertise too much or use too many of these online resources, it creates so much more work that we have to sift through that it's sometimes not really worth it.
Well, it almost requires us to have another technology to sift through it.
Correct. Like we have this lead gen advertising technology that creates the need for another technology, and ultimately, a lot of times on our marketing and our outgoing strategy is kind of going back to the old school way of doing things and avoiding the inundation of kind of spam leads that are really out there. So that's one thing to maintain margins. You constantly have to be looking at what's the best way to do it. What's the way that works for your size.
Yeah, and frankly, I mean, we started this philosophy, 15 years ago when in business, but we always found that it was really, really hard to operate a business with really high tenant turnover because we were constantly renovating apartments, turning over apartments, not even renovating them, just maintaining their basic occupancy. And by maintaining a 60-70% retention rate, we're able to lower our costs and do more things in-house, which then reduce the amount of vendors we have, which then lower our overall costs. One of the biggest places that we've seen inflation really hit is really in the services, between the HVAC technicians, between the pest control guys. Not that they're all doing good work. It's no criticism to them and their business. It's just inflation has really hit hard in those categories, and then hits our bottom line. So we've looked at it from a standpoint of we can basically raise our retention, spend less of our maintenance staff on turning units. We can basically use that maintenance staff to do pest control. We can use that maintenance staff to do HVAC repair, plumbing, et cetera, et cetera. Yeah, and that lowers our overall cost. Definitely,
and at least like the front line of that, instead of there's any HVAC issues, you call the vendor out. It's like, we got to at least look at all that stuff.
Yep.
Out of the gates and around. Right, that's a big part of it. And I mean, there's always going to be something when you're operating a business of like what gets out of whack and what can we go tackle and figure out how do we do that better. That's one of the exciting things about operating being in the real estate space is getting to do this kind of stuff. So we like that, and that's, I mean, it's been helpful, especially when we have some awesome maintenance guys that are willing to go learn and tackle new ideas and go help us figure things out so that we can be on that front line and really maintain our cost structure.
Yeah, they love the challenge of like, oh, it can't be done, or this is really hard, or like, who do we call to fix it? Like, oh, we'll figure this out.
Yeah.
They have a lot of fun.
Yeah. All right, let's talk about transactions. That's, on the transaction front, we have been a net seller of apartments and mobile homes for 5 years now. And we've always come across either we are maxed out on the margin that we can get out of a community, our operating margin that is, and therefore it's time to turn it over to someone else and have them see what they can go do with it. And the other one is that we just kind of get a offer out of left field and it's fantastic and we're going to realize the gains.
Yeah, I mean, a good example of that is one of our mobile home parks, Russell Village. A guy that we know in the industry for years has sold a property, has 1031 money. He owns other parks in the area. He called us up as a friend saying, hey, would you guys be willing to sell this at a certain price? And if you would, I have some 1031 money, I'd love to buy from you. And we haggled back and forth to kind of maximize our profit, but still in a position that, he was willing to move forward with. And it's a tremendous win for Russell Village.
Yeah, we're excited about that deal.
Mm-hmm.
That's going to be phenomenal. We've owned that deal for almost 8 years.
Mm-hmm.
That we've been operating. We've been making consistent distributions there. The deal has been performing well. It's one of the few it's one of the few mobile home communities that we got agency debt on, which is either Fannie or Freddie loans on. We got Fannie there. It's been phenomenal for the deal.
Yeah.
And he's actually going to assume that loan.
Right.
That's part of the process that we're going to work with, and we're excited about that. But that's one where we got an offer. We're going to do really well on the transaction side, so time to take some chips off the table there and realize those gains. So we're still looking at exiting in the second quarter. We have about 5 residential deals right now that we're working through this process on, either from the margin is capped out or we have a really good price offer. Now in that front, we look at groups that are acquiring it. It's definitely been a much longer time frame on the acquisition side now, right? So interest rates aren't that bad. They're in the 5.5 range on residential or multifamily assets.
Interest rates, it's incredible on the interest rates, on the debt you can get on multifamily because it's owned by the government. So Fannie and Freddie still being owned by the government are really subsidizing our rates. And as transaction volume falls, they cut their spread. So for example, when transaction volume was really high, their spread was 250 basis points over the 10-year treasury. Well, now because transaction volumes is cut back, they cut their spread to be 170 basis points over the 10-year treasury. So interest rates are falling in that kind of mid-5s, and if it's low income, if it's affordable housing, they give pricing premiums to that, and they cut the spread even more. So on a property like City View that's catering to a low-income clientele, workforce, it kind of checks a lot of boxes for government housing. So therefore, you can get really, really advantageous pricing, and you can still get debt in the all 5.3 to 5.5 range.
Yeah. So it's attractive. However, timelines are greatly extended in the transaction world right now. Typical contracts, I mean, for a long time, contracts were 30-day due diligence, 30 days to close, and maybe a 15-day extension thrown in there. And now we're seeing 60-day due diligence, which is more to get lending online. 30 days to close, 2 15-day extensions that are in there. So now you're talking about a contract that's like, you kind of get started on it, you get lost in the middle of it, it can be so long.
And don't forget, the day that we accept the offer, it takes about 30 days to get to contract. So there's kind of a free gap, 30-day gap in there. So you're talking, it went from 60 to 90 days, and now it's looking closer to 5 or 6 months.
Yeah.
Which is, it's incredibly long. And the other thing we're seeing is that Fannie and Freddie, as good of lenders as they are, and that they're able to get advantage pricing, leverage is still quite a bit lower. So they were giving leverage in the 75% range, and that's what a lot of people built their businesses on. Now leverage is down in the 55 to 60% range, maybe as high as 65, and that's really hurting the borrower because they have to bring in more equity to the table. It kind of screws up all their math, and we're seeing a lot of guys drop out once they see the actual numbers. And so, for example, like City View, I think we're on our 3rd buyer now.
3rd buyer.
The Grove we've been working on selling, we're on our 3rd buyer there as well. Other properties we're on our 2nd, 3rd buyer. So we're patient, the properties are operating, they're covering their costs, but it's like, when we want to sell something, it'd be nice to actually be able to transact, but we're seeing this. And so if you think about it, it takes 30 days to go to contract, they have a 60-day look. That's 90 days every buyer. So if we're on the third buyer, that means we've already spent 6 months on trying to sell this thing. And we're starting at the next 3-month cycle, so it takes a lot of time to get through these.
But they're good wins for us, so we're working through them, and we're excited about the current transactions we have. We're still, on the opportunity side, we're still not looking to be buyers in the market right now. Even though we had good net margin this quarter and last quarter, and we're seeing our overall operating costs kind of normalize, even a little bit lower, which is very positive. The opportunities we're seeing for us to buy have always come in this form of rescue-ish sounding capital, and the basis is still really high. It's not really that there's any kind of discount out there that we're seeing. So we don't really sense that as an opportunity to get in a lot of those situations, and so we're not buying at this point yet.
Yeah, we had a call a couple weeks ago from a guy that has a portfolio of about 1,000 units, very similar to our type of product. Our average debt per unit is around 50,000. I'm rounding, roughly 50,000 per unit. His average debt per unit was 120,000 per unit on the same type of product, and he was looking for equity to come in on top of that debt. So we'd be at basically, for us to make money, if we were to invest with him, we'd have to sell it for more than 120,000 a unit, and then some to make money. Whatever we put in plus. Yeah. We just didn't see an opportunity there. Frankly, that's what we've seen, because the lenders are now at the point that they want to take a haircut, and sellers don't want to sell for less than their basis. So we're just not seeing any movement in the market.
On the distribution front, we're making distributions every quarter. The deals that we're holding and we have strong margins on, we're making distributions there. A lot of times if we don't have strong margins, as we've talked about, those are the deals that we're selling. So we have a few in the pipeline right now that we're working on selling, and those are not going to have distributions this quarter. We look at deals like the Grove or Fairway and Westside Townhomes. These are deals that we are working on exiting, and therefore we're not making distributions on those deals for this quarter. Overall, we had a strong quarter. Distributions going out on the 20th, so keep an eye out for those. We have our goal day on the 26th as well, so if you're in Atlanta and you can make that, we'd love to have you there. So thanks for watching, and tune in for our live Q&A. We'll be sending that calendar invite out as well, where you can ask any questions. We can go through all the deals in significant detail. Thanks for watching.